Hi everyone, welcome back to the channel. This is Kwa with K2 Wealth Builder, and today I'm going to talk about why real estate investing was never meant to be a get-rich-quick investment strategy. If you scroll through social media for more than 5 minutes, you'll see someone trying to convince you that real estate is a cheat code for overnight success. They make it sound simple. You buy a property, you sit back, you collect the rent, and then you retire, right? But let's be honest for a second. Real estate investing was never meant to be a get-rich-quick scheme. In fact, if you get into this game looking for fast cash, you're likely going to get burned. Real estate is slow, it's heavy, it's capital intensive, but it is also one of the most reliable vehicles for building generational wealth if you play the long game. In this video, we're going to strip away the hype. I'm going to break down why real estate is actually a get-rich-slow strategy, the real face of property ownership, and how shifting your timeline from months to decade is the ultimate competitive advantage. First, let's separate the day trading real estate from the actual investing. Flipping houses and wholesaling are a great strategy, but let's call it what it really are: active job. If you stop finding a house to flip, the income stops. That's not passive wealth building. That's a high-stake trading business. True real estate investing, buying and holding residential or commercial property, move at a snail's pace, and that is by design. Think about the transaction itself. It takes 30 to 45 days just to close a deal. Escrow, inspection, appraisal, loan underwriting. The system is inherently built to slow you down. If you need money to pay your next month rent, you can't just liquidate a piece of the roof. Real estate is an illiquid asset, but that illiquidity is a feature, not a bug. It prevents you from panic selling when the market takes a temporary dip. So if it's so slow, why do it? Because real estate doesn't rely on just one way to make you money. It relies on four distinct pillars that compound over time. First, you have the cash flow. This is what left after the mortgage, tax, insurance, maintenance, and anything that uh, that part of the operating cost pay. In the early years, cash flow might be modest. It's not going to buy you a yacht, but it's building a rainy day fund for your property. And then you have the appreciation. Over the long haul, real estate historically tracked with or beat inflation. A property bought today is going to look incredibly smart 10, 15, or 30 years from now. If you take any property and expand it beyond a 10-year time frame, you will see that its value is always higher at the end of the 10-year cycle. Then the third thing is loan amortization. That's the secret weapon. Every single month your tenant pay rent, they are paying down your principal balance. You are building equity using someone else's capital. Also, the principal portion of your payment increases after each payment. Therefore, the longer you hold a property, the more equity you will have. And the last piece of the puzzle is tax advantage. Depreciation and write-off allows you to keep more of what you make. You are allowed to depreciate any investment property over a 27.5-year time frame. Therefore, you can deduct this from your net income before paying income tax if there are any left to be taxed. For example, say your net income from a property is $20,000. However, if you are allowed to depreciate $25,000 from the property, your effective tax will be zero. When you look at these four pieces, notice how none of them happen overnight. You don't get massive appreciation in 6 months. Your loan balance doesn't drop by half in a year. Real estate wealth is backloaded. The real magic happens in years 7 to 15, not months 1 through 6. The other reason this isn't a quick game is that property requires management. Real estate involves real building and real humans. Lease break, main line burst, water heater fail. If you don't have a system in place, whether that's a solid property manager or leveraging modern management software to automate your reminder of rent and collection, the friction will exhaust you before the compounding interest can bless you. When you treat real estate like a get rich quick scheme, you don't budget for capital expenditure. You don't set aside reserve for a new roof. Then when a $10,000 repair hits, your passive income dream become a financial nightmare. Long-term investors expect the friction. We budget for it, we automate the day-to-day operation, and we move on. If you want to get rich tomorrow, try your luck somewhere else. But if you want to build wealth that lasts, wealth that can sustain your family, fund your retirement, and provide true financial autonomy, change your time horizon. Stop looking at what a property would do for you this quarter. Start asking what your portfolio will look like in 10 years when the mortgage are paid down, the rent have adjusted with inflation, and the equity has doubled. Real estate is a marathon, not a sprint. Secure your boot, pace yourself, and build for the long haul. If you're ready to build real estate, real lasting wealth, and want to learn how to manage and scale your portfolio the right way, hit the subscribe button, leave a comment below with your long-term real estate goal, and I'll see you in the next video. Thank you.